Hey everybody, and welcome to Stock Abilities. In this video, I'm going to be covering options trading through short-term expirations and utilizing the UA and the options flow leaders, as well as some other different terminology and stuff to kind of put it all together for you guys to understand from start to finish. So make sure to watch through the whole video to get the whole concept down here. But we're going to start off here with a UOA. Now, what is a UOA? You're probably asking. UOA is unusual options activity. It's calculated by the volume over open interest. The larger the value, usually the better. Essentially, it's an indication that they're opening a new position. So if you're factoring in that someone is opening a new position on a short-term expiration, let's say on a same-day expiration, there's only so much that they can really be doing in that regard, and it's likely an indication of the directional move for that particular ticker. I'm going to show some examples here, but before I get too far into it, I'm going to give a little brief explanation of what option sweeps to fill are. Sweep to fill order is a type of market order that fills by taking all liquidity at the best price and all that liquidity at the next best price and so on until the order is filled. Essentially, they're trying to aggressively fill that order to get that particular position at that particular price as best as they can. So they're being very, very aggressive, which is also another bullish and or bearish sign depending on the sweeps. You'll probably see this here on the left. It's called option leaders. Top 50 UOA sweeps. I'll link in the description below where you can find this particular option leaderboard here. But we're going to show a breakdown of some of these sweeps that came in not too long ago on a Friday expiration. As you can see here, you have these 0 days to expiration. I have picked out 5 different tickers that you can be utilizing for this example because these worked out really, really well, and I'll show some charts here as well. As you can see here, it's COE, TDOC, Chewy, Riot, and Twitter. And if you go onto the charts here for the same day here, you have the sweeps coming in not too far from the bottoms here. And as you can see, they already took a slam dunk and then they're buying calls on a same day expiration. Kind of leads to pretty self-explanatory here. If they're buying calls after a sudden slam down and they're buying them on a same day expiration, it's very likely that the ticker is going to pop from that given point. Now, this isn't always the case. Sometimes it doesn't quite work out in your favor, but in these 5 different cases with a COE, TDOC, Chewy, Riot, and Twitter, they all ran very similar there, and with the sweeps, if you utilize those sweeps, they came in on the same day, they came in almost near the bottom of the day, and they all worked out very, very fruitfully. And this is a pretty simple concept here. Once again, you look for a short-term expiration. As you can see here, 0 days to expiration, 0 days to expiration, 0 days to expiration. These are 5 different tickers that this applied for on a Friday. So you can utilize this on a Friday. You can use this on other days too. But when you see these on a very short-term expiration, there's only so much they can do with these particular calls or these particular puts that they're buying on that given same-day expiration. So after a big drop, you're seeing people buying in heavily with these calls, thousands and thousands of volume on these particular calls. So it usually relates and correlates to a very directional move. And with these charts showcasing it on 5 different ones, it followed pretty straightforward on each and every one. Now, if you wanted to utilize this on the Trade UI platform, you can do it very simply with the expiration. March 19th here is a Friday. You have an UA. You can increase the UA to whatever number you want. Then if you wanted to increase the particular minimum order value, you can add up 100K. You don't want these small orders. You don't want a $5,000 order. You don't want a $10,000 order. The bigger the order shows the more conviction, especially on a shorter term expiration. And it makes it pretty straightforward to follow with these and follow through with them to make a beneficial move for yourself. The closer to expiration and, same day, for example, there's really only so much that it could do, whether it's on puts and or calls. It very much limits the move the closer to the expiration date. Of course, there's hedges and there's other things involved. This isn't going to work for you 100% of the time, but it's just some basics that you can continue to consider implementing into your given strategy. Usually it works best after a big move up or a big move down, where you see a series of calls come in or you see a series of puts come in. You can kind of start to figure out even closeouts and buying in different types of orders. I'll be covering that in another video that showcases different kind of closeout orders and what to look for in that. So make sure to check out the channel for that video. And thanks for listening in, guys, and you all have a great day. But before I go here, just some quick examples. In addition, you got sweeps coming in here. You got 3:59 p.m. You got Facebook 273. You got a sweep coming in for 280 for March 19th expiration. So these are coming in literally minutes before close, which show a very, very bullish sign for the market. And currently, if you looked at, the overall futures market going on for tonight, you would notice that it's kind of forming a cup and handle formation, which is bullish. And all these sweeps started coming in and piling in right before close. So that's something to consider just, off the top of my head here. These are something else that you can look forward to, is that if you see these sweeps coming in the last minute, you might not necessarily be able to get, options in. But you can utilize the same method for shares. Now, not all options are very liquid, so some options can be kind of dangerous with the spreads. So if you're not very comfortable buying options, you can still buy shares with the same concept. You don't need to know much about options. You just need to know that, if they're buying a very deep out of the money option, that is very likely going to be bullish for you on the short term. The higher the conviction, the more likely that is to be the ideal play for that scenario. As you can see here, the Apple calls here, one of the biggest conviction ones is a slightly deep in the money call. Not necessarily super bullish, bearish. Could be a closeout, could be an exercise, but you want bigger conviction plays to more verify that directional move. The larger the order, the more trustworthy the order, the more likely it is to happen for you in that directional move. How much you want to sort out, I usually prefer to do basically 100,000. You could do even larger than that if you want to really, really filter it out. But over filtering can also help you to miss given plays, which obviously you don't want to do. You want to make sure that you capture the most plays possible, but you also want to make sure to filter out all the bad apples, essentially. You don't want, these different plays to catch up to you where you're following this play and you're like, that's a great play, but if you over filtered, you might be missing a lot of plays as well. So just something to consider when doing short-term expirations. You could set different size orders. You can do 100,000, you can do 200,000. Doesn't matter. Really, you can do any size order that you particularly want to do. So that's really up to you. And that's about all I'm going to cover in this video. I think that covers a lot of the different short-term expiration concepts that you can be utilizing in a very, very basic manner. It's a pretty simple concept here. You have basically out-of-the-money options, and they're expiring in the next day or the next couple days. So there's only so much that they can do with them. And if you're factoring in the fact that these options decay over time, even on an overnight, they're taking a lot of risk holding on to these, especially buying them at the literal last minute of the market, showcasing that they're really, really desperate to get in, and they're pushing that. You can even set it as on the ask, showing an even more demand. So they're paying a higher premium than they necessarily have to in order to utilize and benefit from that. But thanks for listening in, guys. I think this is about all I wanted to summarize in this video. If you have any questions, leave them in the comments below. And thanks for listening in, guys, and you all have a great day.